Please welcome our next panel, When Powell Speaks, Hearts Sink and Values Shrink, featuring panelists Jordan Slone, Jeffrey Goldberg, Chris Milner, and Matt Ferrari, moderated by Henry Stimler.
Before we get going, I think it behoves me to say thank you to Stephen Begg and Hershey Groner and Chaya on another fantastic eCore. While it hasn't had the same insane frenzy of years past, I think the quality is better, and maybe being a little bit smaller and more calm is a better way to transact business. Now, this is my third year doing eCore. The last 2 years were a very, very different market, and we're going to delve into the market. But my focal point today is not where we are now, but where we'll be in the future. We all know where we are now. We all know where the economy is. And sitting in front of us, we have 4 men of great stature that have really made it in this business with years and years of experience. While they don't need an intro, I would like to make a small intro, but I would also like to then turn over to them so they can talk a few minutes about themselves and their capabilities. I'm going to start in no particular order with Jordan Slone, a man that I owe a great debt of gratitude, because thank God over the many years since I met him at a Meridian party at National Multi Housing, sorry Ralph, we've done billions and billions of dollars of business together. Jordan runs and founded Harbor Group International. Harbor Group International owns over 60,000 units, is a fully integrated real estate company, is one of the most active buyers and sellers in the multifamily market today. Besides that, running through Jacob, they have a full loan program and a bridge program, which we'll talk about as well. But Jordan, thank you very much for being here.
Thank you, Henry. It's great to be up here and honored to be up here with the other panelists.
Matt Ferrari from TruAmerica, great socks, Matt. They really are excellent branding. I've seen baseball hat branding, I've seen t-shirt branding, but socks is definitely a first, so I commend you. Matt Ferrari of TruAmerica. TruAmerica is a powerhouse on the West Coast. They have deployed close to $13 billion in assets. They are one of the largest owners in the Northeast, the Mid-Atlantic, Southeast Texas, and the Ohio River Valley. Matt runs all of...
Isn't that the same thing as the United States?
Basically, the important places.
Thank you, Jordan.
Right.
Matt Ferrari manages and runs the acquisition team, and he also oversees operations and asset management for TruAmerica, Eastern and Central United States portfolio. So these are not guys who just buy multi, these are guys that live, breathe the asset class. To my other side is sitting Chris Milner, a man who I also owe a great debt of gratitude. When I was first starting off in the business, when I was interning at Cantor Fitzgerald, I would annoy Chris all the time with questions, and he always had the patience and fortitude to give me the time before he threw me out of the office and told me to go away. Chris runs Cantor Fitzgerald's investment company. Prior to that, he spent many years at BlackRock. He was responsible for BlackRock's business, and then he came over to Cantor and is now the global head of debt and the head of investments. And Cantor has been a huge buyer in the multifamily space, a big equity source for OZ developments. They've also had some great dispositions over the last few years, so he is also very well versed in the market, and he's also a little bit more conservative, I would say. So you've got some aggressive and you've got a little bit of conservative, so we're going to hear from both sides. And then finally, we have Jeffrey Goldberg of Milestone. Jeffrey, for all those of you who are looking for money, Jeffrey is actively seeking to put out equity. They've got a $1 billion fund coming online next month, and they need to put out over $100 million between now and the end of summer. So Milestone and Milestone Group is a private real estate investment firm that buys in all the major markets. It was founded in 2003. It's got a track record of investing close to $13 billion. You also had a massive exit where you sold your business as well. So Jeffrey not only understands the multifamily business and has great fortitude, sat up here 2 years ago and yelled at everybody that the bubble was going to burst and kind of got booed off the stage, and he was right. Don't kill the messenger. But Jeffrey was also uniquely positioned to talk about the equity markets and where they are. So this is who we have in front of us, which I think is a pretty impressive panel of people. And unlike other years, in the last few minutes, I'm going to open it up to questions. And while I know you should never get in between lunch and the Jews, and I know that lunch is right afterwards, so just be cognizant of that with the questions. But Jordan, I'm going to start with you. Everybody knows that the biggest issue we're facing today is values, right? The last few years, people have been buying incredibly tight cap rates in markets such as the Carolinas, markets such as Austin, saw historically low cap rates. And now, in this market, cap rates have expanded, and the markets where they haven't expanded, transactions are impossible to do. How are we going to deal with the problem of values? Is there a solution, or are we all screwed?
All jokes aside, there's no magic solution. It is what it is. First of all, there was a frenzy of people buying. Cap rates been going down, 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 down. In some cases, really too low, even irrespective of interest rates. And I think Jeff maybe said it 2 years ago. It was just too low, too low. But there's not any secret about that. How to deal with this. It's just, I think, first of all, not leveraging too high in the first place. If people already have, okay, it's fine. Then people should be looking to do recaps and locking in fixed rate financing, and then ride out the storm. That's really my answer: is prepare yourself to ride out the storm.
And what if you can't ride out the storm? What if, and this kind of leads into the next thing, and we're not going to dominate with this just with Jordan, but what if you can't ride out the storm? You're doing something right now. You're rescuing a large portfolio, which you're doing. Can you just tell us a little bit about, because we've all heard the term rescue capital, and I think it's a myth, like alligators in the New York sewers. I think it's nonsense. Rescue capital is BS, but you're really doing something now with rescue capital.
First of all, we don't comment on any of the deals that we're working on, particularly in front of 300 people. But what we're out there was we're trying to help owners that really, in some cases, I've seen deals where a property's worth $50 million and it's got $75 million of debt on it. So that needs to be completely restructured. And we've been through many, many cycles. We went through the cycle, in fact, I've known Jeff for a long time, been through the cycle of the late 1980s, early 1990s. And then, of course, the dot-com bubble burst in 2008, 2009, and then COVID. So we've kind of been through a lot, but really the key is to, even in some of our, sometimes also, by the way, you just have to sell. You just have to sell, be done with it. Everybody knows sometimes you spend 90% of your time on 10% of your portfolio.
Yep.
That's also not good.
Hey, Jordan, can I ask a question? So in that situation where the owner is out of the money, or he's really upside down, is there rescue capital for something like that?
Yeah, there's rescue capital, and it's going to have to be a three-party deal with the lender, maybe breaking up an A note and a B note, and those deals, I think, we're going to see more and more of those.
But let's move away from let's just stay on values right now. Matt, you had a tremendous last few years buying a lot of properties. You've bought a lot. You haven't sold that much. This year you've kind of taken a little bit of a pause and been very selective. But the stuff that you bought in 2020 and 21, how are you seeing values?
So it's funny, I was just at ULI last week, and there were some lively debates, and probably one of our competitors, one of the biggest buyers this year, has bought about $2 billion, stated in a room full of 60 executives in the industry that cap rates were 6 to 6.5 today. And many people in the room got angry.
Yeah, or fainted, right?
Yeah, but I agree with them, particularly on the older product. I think what we saw in 21 and 22 was there's no differentiation in cap rate for C, B, A, and market.
Yep.
And today, most deals aren't clearing. We joked in January that 2023 was going to be the year of separating the delusional seller from the market seller.
Yep.
And there's been a lot more delusional sellers than market sellers, and the market is steadily headed south. We did get a little reprieve last week. It was probably the first time Powell spoke where values didn't shrink.
Yep.
So that was great. But No, I think realistically,
But that wasn't the norm. Typically, every time
I
Powell
know.
speaks, I always the thing of the name is when Powell speaks, hearts sink and bank accounts shrink, and that's what we're seeing. This was like the first time he spoke, and we didn't see a jump. We saw it coming down, and that makes it also so hard to kind of judge deals because that movement in Treasury is so volatile.
Well, so I have to caveat that when we prepared for this panel, Henry asked us all to be positive and honest. I said I'll do my best, but I think realistically, look, deals are still pricing to negative leverage. Sellers' expectations are still a few months ago. It's not surprising. You got a BOV 90 days ago. It takes you 4 weeks to go to market. Rates went up another 50 basis points. You get your bids, and you're like, no way am I selling. I do think that's starting to turn. I think there's the deals that are now clearing. We're getting close to neutral leverage, especially with this reprieve in rates.
How do you define clearing, by the way?
They get tied up and closed.
So they don't get retraded to the bone.
Well, they could get retraded, but if they close, then they cleared at a price. But I think there's a lot of deals
I thought you meant, when you said clearing, I thought you meant clear the mortgage.
well, that's important too, but what I've noticed is the groups whose deals aren't worth the mortgage, so I'm talking to the wrong seller in that situation.
So you're talking to the lender.
Exactly. So, but again, I think the delusion where you have people going to market thinking they have equity in their deal because they bought with a high leverage bridge loan in 21 and 22, and the reality is it's not worth the loan balance at all. Particularly, a lot of the debt funds lended to groups who are buying C real estate that no one wants right now.
Yeah.
So that, I think there's still some pain to come there, but I also think there's lenders who are saying, well, I don't want the real estate either, so we'll extend and pretend to hopefully have rates come down.
Do you think? Go on, Chris.
So Henry, I think one way to kind of step back from this is to, notwithstanding the fact that we're all real estate people, remember that a cap rate's just the inverse of a PE ratio, right? A 4 cap is a 25 PE, a 5 cap's a 20 PE, a 6 cap is a 16, 17 PE. This market trades like every other asset class, right? Paying a 25 or a 30 PE is too high. In a world where interest rates go up in a historically significant fashion, you don't expect the valuations to persist. And I think in many instances, we in real estate forget that we're buying a financial asset, right? It's undergirded by bricks, mortar, and dirt, but at the end of the day, we're all in this to make money. And I think the cycle, as we look forward based on that kind of very, very fundamental premise, is I think we're in that investment picking segment of the market. It's not like it was a few years ago where you throw a dart at the Wall Street Journal, buy that stock, and it goes up, right? That's what a lot of us were all doing in that prior cycle. Now, you've got to grow NOI. Just like in the regular stock market, you've got to make the E go up. That's the type of company that you pay a high PE for, is one that has high sales growth and income growth. And I think that's the stage of the market we're in now. And the way we all have to look at the world over the next 3 to 5 years is not, can I buy this thing, cheap? There will be those opportunities, but they're more opportunistic. I think in the core plus arena, you've got to look at it and say, can I run this building in a way that's going to grow the income, top line and bottom line, in a way that out exceeds not only my expectations, but the market's expectations.
Right, which is great in practice, but in theory, we've seen rents dip, right? So rents the last few years, maybe because of COVID, maybe because of other reasons, maybe because of population, rents went through the roof. Tampa had 17% rental growth. Austin had insane rental growth. So while in theory, but Miami's wonderful. So while it's great, and Chris, I totally hear you, in practice, we're seeing the complete adverse. We're seeing rents maybe not go up, but they're all kind of plateau or go down. So how do you grow NOI? Jeff, I see you're chomping in the bit for this one.
All right, so first, in order for me to speak today, Henry made me tell you guys, I did provide Prozac as you leave, so everybody can get just one pill per person, please. Look, in reality,
and I'm trying to be positive, but I'm still honest, right?
It's a tough market, but the fundamentals in the long run still are really good for multifamily. And so to your point and to Jordan's point, you've got to match your business plan and the financing. So at the end of the day, what we do is we look at the opportunity, we say, okay, this is a great 5-year hold, a 7-year hold, but you know what? We're going to have some tough sledding for the next 12 or 18 months. And so, we're very realistic about it. So we may look at it and say, you know what? There is no rent growth. And we're going to have to buckle down. We're going to have to keep heads in beds. But then, if you look at the fundamentals for multifamily, certainly for 25 and beyond, it looks pretty good.
It does look pretty good?
It does.
Why does it look pretty good?
Because what's impacted multifamily today is the amount of supply. And in a good amount of those markets, the supply, we've got excess supply until sometime in 25, and then it drops off a cliff. And so if you can really hang on, you're really going to see the market strengthen.
Jeff, I would agree, but I think it might be toward the end of 25, maybe even 26.
Depending on the market.
Yeah, because a lot's going to have to be absorbed.
And Jordan, is the reason why things are going to stabilize in 25 is because so many of these development deals are now shoveled down because the cost of construction to build multifamily has gone through the roof? What is the reason why it's going to rebound? Is that the sole reason?
Not the sole reason.
Okay,
Not the sole reason. I mean, we've been around long enough. You see actual properties be repurposed.
Yeah.
So, maybe many people in the room don't know this or haven't seen this, but I've seen properties where they just bulldoze it and build something else. And that needs to happen sometimes to some of the inventory because it's got functional obsolescence, it's not safe, whatever the case may be. They're redoing an area, but that combined with the cost of construction.
Okay.
I also think that we have to be attentive to the fact that the media, all of the things we're seeing about real estate, is mostly predicated on the office market, which is going through a secular decline, right? Think about the regional malls of the 1980s, 2,500 malls, 3 in every one mall town. Those properties have been declining over the last 7 or 8 cycles. I think that's what's going to happen to office, right? That's a secular downturn. Multifamily and industrial are just in a cyclical downturn. This economy is going to go through a cycle, and these properties are going to perform over time. I think a lot of what you're talking about, Henry, is the macro slides that we see up on presentation boards like this.
Yeah.
And when I go back to that stock picker's mentality, right, you have to not only pick the right market, but the right submarket and the right property. Right? Everybody in this room is a stock picker by definition, right? There's only a few people, like the Blackstones and some of the really big portfolios that are going out and buying the market.
Right, buying in bulk.
Buying in huge bulk and buying
But
in
most
market.
people are picking their spots. They're saying, I like this, I like this
Exactly.
property, this market, this thing. I want to talk about growing NOI in a declining rental market. Jordan and Robert, in a way, you do this all the time. You guys are notorious for going in and pushing NOI, bringing down expenses, and running, and then we'll come to you, Matt, on this as well, because TruAmerica does as well. So what's the secret sauce? How are you, in a declining market, still being incredibly active? We've had a very active, I know you're buying very selectively, but one of the secrets that you and Robert always do is you go in, you push NOI, you bring down expenses. What is that?
So 2 things. First of all, I can't say that right now it's easy to bring down expenses, particularly with the insurance.
Yeah.
Insurance has been a killer for the last 18 months or so. In terms of bringing down other expenses, I would encourage everybody to go to Robert Friedman's panel. When is that? Today, tomorrow? Tomorrow. And Robert's
Shameless plug for another panel, boys.
He's the president of our management company, and I got to tell you, everybody at our company, from me, all the executives, we're all focused today on reducing expenses wherever we can, and we spend a lot of time on that area. You have to.
You have to be in the trenches today. You have to be. Matt, how are you pushing NOI on the properties you bought? You just closed on 2 deals. What is your plan? Do you think you're going to push NOI on those 2 deals?
So one of the deals we bought recently in Southern California, we try to focus this year on buying from people who need to sell, and we bought this one from a dead guy. So
From a dead guy?
yeah, it was his trust.
He needed to sell.
Yes, he needed to sell. And
Did he sign from heaven? What did he do?
he's
Use a pigeon
self-managed.
for carriers?
He's self-managed. There was a big mark-to-market opportunity, but also on the expense front. And so, I run our acquisitions team as well as about a 20,000 unit portfolio. The last couple of years, 20% of my time was on operations because it just mattered less when rents were going up 30, 40%, and 80% was on acquisitions. This year it's flipped. I think it's going to be tough to grow the top line for the next 12 to 18 months. Your renewals, 75% of our portfolio is negative across the country. Negative. That's just a fact.
You told them to be honest.
75% of your current portfolio is. Where's that Zoloft? Can I have it right now?
Well, I just want to know, was he dead before or after the negotiations?
He could have said 100%. Instead, he said 75. He's upbeat.
Yeah, you want to know where we're not negative? Is California, because they have such stringent rent control. They just defer their rent growth. Right. That's why we're not negative in California. We have 20,000 units. The flip side is our renewals are still positive. So we're about flat on the top line.
Because less people are going to move right now. The cost of moving, credit card debt has gone through the roof, car debt is through the roof. So,
but I do think there's concession hoppers. So I think you have developers who are desperate to lease up as quick as possible because they're buried by high interest. So they are probably offering more concessions than they normally would in this soft market. So I do think there are people chasing concessions. And look, we have a largely B portfolio. I'm surprised at the impact from the A product on our rent growth. On the expense front, take insurance out of it. It is what it is. Like, you can control it a little bit. One of the benefits we have using third-party management is we have our own insurance program. Yep. We have all our management companies. Yes, so we just we pick which management company has the best insurance program if ours stinks. That's kind of how we control that. But I do think there's operators out there who just accepted large inflation increases on their contracts and certain services, do not rebid them out regularly, and we have seen relief, or at least keeping them flat. But you've got to get out of the lazy mentality where your management team just says, oh, inflation.
You just got to be on top of them.
Right, but you got to be in the weeds with it, like it's line by line. We have seen leveling of that. We had a landscaper that went under on 2 properties in Orlando. We brought in a new landscaper who wanted to charge us double. I said, absolutely not. They found 4 more landscapers. One of them said they would match the previous bidder. When we went to terminate the one we hired, they said, we'll match the price. Yeah. But you've got to get that granular with it in this market.
And that's how granular you are. About a landscaping built on 2
Yeah,
properties.
I know about the landscaper.
Yeah, which you typically wouldn't have known about if not for this market. Right. And I think that's always the message, guys, that comes out of this panel year after year after year, is too many times guys buy property and they think their job is done. They bought the asset. The job really starts when you buy the asset, and now you have to manage the asset. Real estate is a living, breathing organism. It's not going to run itself. And if you're not in the weeds, you're going to get hurt, especially now.
And here's to add to that, there's going to be less equity out there because the money supply is shrinking. So it's hard to make money when there's actually the money supply is shrinking. All these fund investors, we have a joint venture business, 90% of them are on the sidelines. They're herd mentality. The fund LPs all have lower allocations to real estate. So when it comes time to allocate to real estate, they're going to remember who operated and performed well in a tough time and who did a few little things that differentiated themselves to squeeze out a little bit more NOI where their other sponsors might have just been kind of sitting there floundering. So I think the operators will attract better capital going forward.
That's so clever. And you're an equity guy, so you know this, right?
Yeah. And I think this market really separates the wheat from the shaft. I mean,
the boys from the men.
The last 5 years, you didn't have to be a genius to make money in multifamily. Because, markets were good for everybody. But this is the market where, to your point, you really have to do intensive asset management. You've got to really be on top of property management. You've got to know, really anticipate negative variances. What is my renewal trends? Because if not, you're going to get caught. This is the market where, every day, we have asset management meetings. It's that intense.
Chris, let's talk about something rather positive. And Jordan, you as well. Jordan, you just sold
a landscaper maintaining his price. That's positive.
But this is like a nice thing. So and this is, you guys have had some really big wins this year on sales. You sold a very large portfolio through Newmark, another plug for Newmark, in Boston, 1,900 units, crushed it on that sale because I know when you bought it. You sold your property in Vegas this year, you crushed it. So there has been some real wins. Can we talk about what tells you when to sell and what determines when to sell, and how have you achieved those wins, Chris? How did you achieve that on that sale?
So I think the other kind of big macro thought that we can't lose sight of is that this is an incredibly illiquid market where non-public information is not only free to trade, but it's encouraged, right? We all know more about our individual assets as a seller or a buyer, right? There's no insider information. Our sales that Henry's talking about, we've sold probably $250 million of property in the last 12 months and bought about the same amount. The sell side cap rates were inside of 475, and the buy side cap rates were around 6.
So that's
for
There's your positive news, guys.
Similarly situated product, right? Not, B's and C's, one on side. So I think you can't lose sight of the inefficiencies in this market. We talk about motivated sellers all the time. Don't forget, more importantly, there's a lot of motivated buyers out here, right?
Yeah.
You get people who are in the last couple of weeks of their ID period on a 1031 exchange.
They're panicking.
You can't even think about paying taxes, right? Notwithstanding the fact they've probably got capital losses somewhere that they could just offset them, but intuitively, you can't miss an exchange. And so we focus as much of our time finding motivated buyers as we do motivated sellers. And I think that drives the business. And like I said, it's not like the stock market in that sense, right? We can sell the same stock at a different price to different people on the same day, right? There's just a lot of different points of view. And there's no exchange that anybody can look at and say, that's the price for, 123 Main Street.
Yeah. So that's it's been quite good for you on the selling at the low cap rates and buying. So we've just closed 2 deals where you bought really, really good cap rates.
Sure.
So that's what, Jordan, what about you? So you've sold quite a lot this year, actually.
We've sold a lot over the last 3 years. And just the last 2 years, $2.8 billion just in the last 2 years, over $1 billion this year. But we may be unique. We're very much a disciplined investor in the sense that when we hit our business plan, if we have a 7-year business plan and we hit it in year 4, then we sell.
We're getting out.
We're getting out. We hit our business plan. This was what we wanted to achieve. We achieved it. We're getting out. So
no emotional attachment to the real estate.
There's no emotional attachment to the real estate, but. I think it's important also, again, that when in the capital markets environment that we were in, we also, I can remember our team, several of which are here, in the first quarter of 2022, we said, interest rates starting to go up, you have the Ukraine situation, we need to reduce exposure. And by the way, we have some floating rate debt. Thankfully, it's a minority in our portfolio, but we took it down from 36% at the beginning of 2022 to 20%, about 20% today of our entire portfolio is floating rate debt. We have caps in place. In some cases, we actually extended the caps 6 months ago when rates weren't where they are now, even though we paid a pretty penny to do that. But that's another reason why we were selling, is because we wanted to reduce exposure to interest rates.
And the Boston sale, what was the reason there? You've achieved your business plan?
We achieved our business plan.
And that was a tremendous execution.
We bought that portfolio in 2018.
Yep.
And we sold it this past summer, so we owned it for 5 years. It was a big portfolio, $500 million sale. Again, we achieved our portfolio. Boston's been a great market for us. It still is. We still have other assets there. We recognize that with a lot of difficulty in different markets, that buyers still recognize that Boston is a good place to be, particularly for the long run.
So, and this is for you and you guys, for Jeff. If you're buying today, so there's kind of 2 ways to look at it. I can either buy from someone who's dead or someone who needs to sell, right? That's why I can take advantage of the market. Or I could just buy good real estate, let's start with you, Matt. What are you looking now to buy? What is kind of your motivation? Where do you think is going to be the best opportunity to buy and why?
So right now we're mostly deploying equity from our second fund, and we're in fundraising mode. So all the fund investors know the first deal or two you put in the fund gets heavily scrutinized. So we're probably more picky than ever. That being said, we do have a deal under contract in suburban Boston, because besides California, suburban Boston is where I'm still getting positive lease trade out.
It's a great market.
Plus, most of their properties have an affordable component, and for several years, you couldn't raise the rent on those at all. So there's a huge mark-to-market story in that 20%. So bring them to the market affordable, what they'll allow. I think we're not trying to buy with negative leverage, at least neutral leverage day one. Again, that has to do with the scrutiny of the first few deals that go on our fund.
Are you still a floating rate borrower now, or are you deciding to? Because
it's almost impossible to float unless you want to go to a debt. Because the agencies will size floaters based off where the short end of the curve is. So we're trying to do the 5-year fix with flexibility.
But a lot of your portfolio is floating.
We were floaters up until mid-21 when Powell said rates would be lower for longer and inflation was transitory, but we were raising rent 40%. We realized that didn't really make sense. So we pivoted to a lot of, and this is why we're not a seller of what we bought in 21 and 22. Most of what we bought in 21 and 22 has fixed rate debt between 2 and 3.5%. The one mistake I made was swapping for 3 years in the low twos instead of 5 years in the mid twos.
That one's perfect.
And then the stuff we bought in 20 was floating, but we bought rate caps at strikes at 75 basis points. Those are finally coming due in January. So it's going to stink buying a new one, but we were getting like 15% cash on cash, so no one's feeling bad for us. Today, we would do a 5-year fixed or try to get something with flexibility, because I think our view is rates will be lower. I don't know how much lower, but lower in the next couple of years.
I want to come to rates. Let's say on the topic of places to buy, markets
So
you like. So Boston,
I think,
you
look,
love.
we're historically a Class B buyer. I think there's a flight to quality. There's nicer deals clearing, so we can, our fund is a workforce housing fund, so I need to at least make it look quasi-workforce.
Workforce housing,
within a big workforce box.
That's been an area, the nicer property. The last couple of years, we've mostly focused on Class A.
Yeah.
Class A.
I'm going to come to your lease-up play soon. Jeffrey, you've got $100 million to put out. What are you going to look for right now? What is going to make you want to put that money out?
So in this market, I think both of you guys are right. The stuff that is really bad or that's in deepest trouble right now tends to be the lower quality, right? The better it is, the longer the owners can hang in there. And so I think this is the market to high grade. And so we are trying to avoid just pure commodity product just to buy. I think Jordan's right. It doesn't have to be a distressed sale. There just has to be a story to it. So if the business plan, has been fully realized, and then you have the opportunity to then take that property to the next level, that totally works. At the same time, we just bought a property where the distress was not the real estate. The distress was from the owner because he had a ton of commercial exposure. And so he needed to create liquidity. It's a whole lot easier to create liquidity with multifamily than office, but he needed to feed the problem children. So, that was a great opportunity. So for us, we're looking for opportunities where we think we can take an asset somewhere, right? And the market can be a little bit soft, but we're not just buying it for today. We're buying it pursuant to that business plan. So whether it's 5 years, whether it's 7 years, there's got to be a story that we can get excited about it.
And let me ask you a follow-up question to that, and then I'm going to come to you, Chris. Let's say some chap, younger guy, bought a property, put on floating rate, bridge finance, leveraged up to the wazoo. Obviously, values have come down. He needs rescue capital. But the property, the fundamentals are great, and you would like that. You would really be a candidate to say, I'm going to give you a hope note, and you're going to step in. You've been doing that. So
100%.
Because and what are the factors that work for you to do that? Because I know in our own experience, we're spending 30% of our time doing new deals, but we're spending an enormous amount of time talking to our existing borrowers, especially the younger guys, and holding their hand and coaching through this tough time.
Right, so it's not only what you're bringing to the table from an asset management standpoint. So, what we like to think is, at one point, we probably were managing about 60,000 units ourselves. Ultimately, we sold our property management company along with a publicly traded REIT, but I think we know property management as well as anybody. So I think we're able to bring some real sophisticated asset management tools to the table to at least guide and look at what are they doing at the property level, how do we create some both efficiencies and be able to position that property to be able to take advantage of some upside. And for the owners, sometimes when you're holding on, it's really hard to see through, all the fog and smoke. And so to be able to, look, we're probably one of Freddie's, most active borrowers. So I think we can bring certainly the best terms to bear in a refinance to really be able to, and again, I think what Matt was saying, 96% of our portfolio is fixed. But we've been fixed forever, right? So we were fixing.
Yeah, you've been singing the Bible of fixed forever.
Right, because at the end, we're in the asset business. I'm not in the capital markets business. And so, I know that the assets. I can't predict the capital markets. And so what we'll do is we'll put on financing. We'll have some flexibility and allow us to breathe over the next 3 to 5 years. And then, hopefully, if the markets recover faster, great. If not, we can execute on a business plan.
And then the current equity, rather than be wiped out, is given a hope note, right? Saying that if things should come back, obviously the debt will be first, micro will be second, but anything left over will go back to repatriating that equity.
Yep. We try to create an opportunity so that there's some opportunity for not only that sponsor, but for his LPs to create some upside for them to be able to do a transaction, because otherwise he'll just give back the keys.
Chris, you kind of sat on the sidelines for most of this year, and now towards the end of the year, you've come back with a vengeance. You bought $205 million deals in the last 2 months, and you're looking at another $65 million deal now. What's brought you back to the market, and why were you on the sidelines for so long?
So I think, kind of to your point, one of the just simple metrics that we use is if you can't finance an asset on a 10-year interest-only basis accretively, you should think whether or not you're paying too much, right? In the core plus space, right? If it's a value add, it could be different, right? But in a core asset where you're buying something that has a stabilized rent roll, if you can't finance it accretively, like I said, you have to evaluate whether or not you're paying too much. And so in, I guess, the middle part of last year, it became pretty obvious. Cantor has the benefit of being one of the primary dealers with the Federal Reserve, so we have a pretty big fixed income trading department, and it's beaten into your head when you join the firm. If you want to be a bond trader, go to the 4th floor.
Yeah.
Don't go to the real estate floor, right? We're not bond traders here in the real estate business. And so when those things kind of come around, we didn't buy anything from the middle of last year to the middle of this year. I think the inflection point really happened for those of you in the last panel when rates kind of stabilized after the couple of big moves, and you could finance things accretively, albeit less than 25 basis points of accretion, but still more than nothing. We started to dip back in, and we focused on assets that we couldn't have touched in prior cycles. So the one we just got together with Jordan and his team on is in a market that just not only wouldn't have been for sale at a price we could have liked, but it just wouldn't have been for sale. It was owned by the developer that developed it, and they had no intention of selling it. So you get a chance to buy those types of assets in this market, you do it. I think you also have to bear in mind the other place where we've been investing capital is frankly in the investment grade CMBS market, where a BBB bond is between 13 and 13.5 yield to maturity. Right? It's hard to convince yourself to buy real estate at whatever single-digit cash on cash you want to convince yourself you're getting, versus an investment grade bond that has some liquidity. It's not a treasury, obviously, that yields 13. And so I think you have to look at your options and not just say, I buy multifamily properties no matter what.
Yeah, because in the old days, anything you bought, you made money on. Today, it's a very different story. But because of that, you're finding opportunities that you didn't. Jordan, you've kind of changed your business plan from when we started doing business, which was predominantly value add. You've been buying in the last few months a lot of brand new lease-up deals direct from the developers, because the developers are choking. They all took floating rate money. 2 years ago, SOFR was at 10 basis points. Now SOFR is 525. Their cost of borrowing is 9%. The bank's calling them off the hook saying, give me my money back. They cannot suffer through a long lease-up, so you're stepping in and taking advantage of that market. Talk us through.
Why did you tell this to 300 people?
You know, with me, I'm an open book.
I know, but I don't need any more competition.
You don't have a lot of competition, but talk me through this thesis. And you've also not been scared to buy in markets that have had some overbuilding, right? You bought Austin. A lot of people are scared. We closed the deal in Austin. Explain this. Talk me through.
Miami. We love Miami.
Yep.
There's a lot of building
Yep.
going on in
Yep.
Miami. Listen, again, we felt like as you weren't going to have rent growth of 10%, 15%, 20%. I remember one of our team members came in and gave a pro forma and said that the rents were going to go up 15%. I asked him if he wanted to get fired.
Did you fire him? Israel, you still have a job?
He turned out to be right, but that's not gonna go on forever. So, I'll tell you, there's always exceptions. But we felt like the last year and a half, as rents were coming down, that there wasn't really a good value add story. I mean, Henry, the brokers of the world, everything, even 3 years ago, even a brand new property, people would slap on the package, value add.
I'm going to put ring cameras in, I'm going to put up a new sign, and we're going to crush it.
Exactly. Everything here was value add. But seriously, though, you have to be able to increase. Our formula that we've used for years is we had to see, this sounds modest compared to the last couple of years, but we had to see at least 25% rent growth over a 5-year period. Oh. Again, for most people in this room, that might sound very, very modest. If we couldn't see that, and I'm talking about over the last 10, 15 years, if we couldn't see that, that is not a value add deal in our opinion. So we shifted, as you said, brand new stuff, things that are still in lease up. The developers are you cannot get a takeout loan for property that's 35% occupied.
Yeah. But you could buy it all cash.
We could buy it all cash, or convince the existing lender to stay in the deal for us.
For 99%. So when the existing construction lender will stay in the deal, the company will buy 99%. The original developer will stay for 1%.
Henry, please stop telling everybody everything that we do.
This is meant to be an educational panel, Jordan. You can't keep all the secrets of the trade.
Okay,
You've got to
so
teach
you can
the next generation.
talk about which direction you think interest rates are going in.
No, that would be too paro and blasé. Okay, so, sorry, keep going. So you can keep going. Sorry.
No, I mean, you might as well just tell them everything.
I want you to give them advice.
All right. No, seriously, but really, that's been it's times like this also you have to think a little bit longer term. And I don't know who said it, but I think Jeff said it. It's true. The lower end is going to have a really tough time recovering. I don't care what you do to the property, unless it's a fantastic location.
Yeah.
But otherwise, it's going to have a really, really difficult time. So the newer assets are going to be able to ride out the cycle better. Newer assets in good locations. Even though it might be a tough sledding the next couple of years, might not have a lot of cash flow, but when the market comes back, those newer assets are going to be the ones that everybody wants. And when I say everybody, I'm not just talking about individuals, I'm talking about pension funds and REITs and insurance companies. And so that's what we've tried to do.
Matt, and then we're gonna come to our last question. I'm going to open up to the floor. Matt, you're traditionally a value-add multifamily buyer. You've just heard what Jordan says. I would say 50s, 60s, that kind of property is going to have a tough time in this new cycle.
depending on where it is.
Yeah, because there's always going to be exceptions to the rule.
Yeah, right.
How are you going to deal with your current portfolio and moving that current portfolio, and are you going to now swing towards best in class? What is your?
Before he answers, I know a lot of them. They have a very good portfolio.
Yeah,
I mean,
I'm not dumping on the portfolio.
Okay.
But it was traditionally.
I bought a few of them from
That's
you.
right.
Yeah.
And we bought from you.
But Jordan loves pass the parcel. Like 2 years ago, I asked Jordan, how do you make money in this business? He goes, I buy a deal, I sell it to this guy, he sells it to this guy, then he buys it back to me. So, and now the music stopped. So pass the parcel doesn't work anymore.
I would say, first of all, like our funds are called workforce housing funds, so we don't get pigeonholed into being a value-add buyer. And so I think the box is bigger there. But then how do people define value-add? So we call it, at TruAmerica, we call it like the 3 pillars of value-add. There's what everyone thinks of, which is construction and rehabbing properties, which is important. But then there's also just implementing institutional management. So we bought a property during the depths of COVID from an 85-year-old grandmother where our acquisition officer had milk and cook.
You really are focusing on the older generation. What do you go to nursing homes and give out your business card?
But so like all we had to do was show up and bring in real management for the 85-year-old grandmother property, and then there's implementing technology. So coming up during
this one's dead. This one's 85. This guy's
everyone has their own strategy.
I like this one.
He focused on the new properties. He focused on the.
I've always got the old people. Okay.
And Chris looks at every property like a stock.
But
so, Jeffrey just complains.
So you have your traditional value add. You have your implementing real management, which again in many markets it's still very fragmented. And then you have implementing technology. So look, during COVID, when you had the mom and pop who wasn't using revenue management and they raised rent 6% and you could raise them 20, all you had to do is flip on revenue management and take the emotion out of pricing. So there's all those different buckets, and you can find those components of value add in new deals, in core plus deals, and in old deals. Our portfolio, we always focus on 80s or newer. Again, why did we buy older product? Because in 18, 19, 20, cap rates were 50 basis points wider than the new stuff. So it's rational.
Now it's not.
Today they're not wider, so why would I go buy an 80s deal when I can buy a 05 deal, and that will be received better when I need to sell it, at exit. So that's how we're thinking about the market today.
I like that. This is going to be the last question, and then we're going to turn it over, and this should be like a rapid fire round. Jeffrey, where do you think interest rates are in a year?
I think where we are now may be slightly lower, but I don't think you're seeing. It's going to be higher, longer.
Chris, you agree with that?
I think just longer. I think we're higher now, and I think we can kind of stay where we are.
Jordan?
But I don't think going down.
More or less where we are now.
So you said honest and positive. The positive answer is I think the 10-year in January could be closer to 4. I think the short end of the curve will come in faster than people think. I think the job market is a lot softer. If you look at the jobs report last week, it was basically healthcare and government. So I think the short end of the curve can come in quicker than the Fed maybe is thinking, because I think the economy is going to be worse in the next 6 months than is projected. The long end, if you really think about rates, rates don't react to inflation anymore. We said inflation was beat in January. The biggest component of CPI is shelter. It was trending down big time the first half of the year. Now it's negative. I think the long end of the curve is most impacted by how much debt we need to issue. That came in $76 billion lighter than the Treasury had projected in July. So I think instead of focusing on CPI and PC going forward, people are going to be very focused on when Treasury announces how much debt they have to issue. So that's where I think it impacts rates. But the positive is I think the short end comes quicker than is projected and will be closer to 4 in January.
It's so funny, me and Bill as lenders, principal lenders and also brokers, every time we see bad news, we're so happy. Oh, bad jobs market, fantastic. So it's like a very weird paradigm. Last question, then we open up to the floor, and I love this question. Because you guys have experienced, because you guys have seen what you've seen, if you could go back and talk to yourself and tell a 26 or 27-old version, one piece of advice, if you close your eyes and see that young man that you were a few years ago, not that long ago, but 25, 26, 27, what would you tell him, knowing now what you know, what would you relate to him?
Don't leverage to the hill.
I love that. Chris?
But buy it all.
But say again?
But buy it all. Don't leverage to the hill, but buy it all. Look at the prices back then per door
Oh, yeah.
versus today. If you want to just talk about multifamily, look at the stock market back then, right? Just buy it all, but do it with an amount of leverage that you can kind of go through. But in hindsight, be fully invested.
My grandfather, when we would walk back from synagogue, he would look at the building and goes, I could have bought that building for $12. You know, he always spoke about the buildings he could have bought. And my father said, so new daddy, why didn't you buy the building? That's what he would yell at him. Jeff, what would you tell yourself?
So I think Jordan said it. I mean, to stay disciplined. I think the issue that everybody got was that it got very emotional. And people just started chasing, and I could finance it. And so I think if you just feel good about what you're doing, then, you know, all in. But when you start to get into that realm of uncomfortableness, then, you know, you got to pull out.
So 2 things. I'll copy what I heard one of the founders of one of our LPs say. He said, don't confuse bull market with brains. And I think the last few years we had a lot of people enter the business that confused the bull market with being really smart. And I'd say the more you learn, the more you earn. So I think if you can continue to be learning across a variety of components of, you know, don't just be a deal person, don't just be a capital markets person, but get your hands dirty with everything, I think you'll do well in the long run.
I'm going to answer this. I know it's not traditional for the moderator to answer the question, but I think about what's going on in light of the world, and what's going on in Israel, and I think it's on the forefront of everyone's minds, and the rapid rise of anti-Semitism, and the fear as well for a lot of people, younger people who haven't really seen this, who've been living in a bubble that everything was good, and now you're seeing this. I would say this too shall pass. So let's open it up to the floor. Any questions from anybody?
There's one over here.
Yeah, go ahead. Stand up.
Are people still flowing out of real estate, or are we back in a place where real estate kind of still makes sense?
So from an asset, the question basically was, I think, as we look at asset allocation questions, are the major institutional investors and retail investors kind of going away from real estate from an allocation or going towards it? And I think we're at that inflection point where the stock market went down quite a bit, and it created a number of, you know, call it the denominator effect if you want to use the CNBC term. But in a sense, your portfolio, part of your portfolio went down in value, so you were overweighted to another one. I think the rebound in the equity markets has kind of corrected that scenario.
Yep.
And I think real estate is getting to the point, assuming, you know, before last week's run up in rates and then giving it back, you know, at the end of last week, or 2 weeks ago with this last week, I think we're back in a spot where you would start to hear people say that real estate is investable again, and that individual and institutional investors can allocate to the product. I don't think you're going to see those allocations going up in the near term until some of the media fan, you know, blowing goes by. But I do think we're getting to that point, yes.
But can I just add one thing? What we're seeing, we're actually in the middle of raising a fund, and what we're seeing is shifts in allocation. So people who were, you know, they always invested in multi-sector, right? And so now they're saying, you know what, I think we just want to do specific sectors, and whether that's multifamily, whether that's industrial, that could be a, you know, specialty, you know, warehouse or something. So I think real estate is garnering it, but I think you can't just broad brush it and say real estate. Because I think there's real outflows on the commercial side, but I think multifamily is certainly holding its own.
Anybody else? Yeah, please stand up.
I think Jordan, you also mentioned earlier, is there a chance like insurance prices are going to go down, that could eventually be you know, I'm a Florida, I was originally Florida, I live in Israel now, but as Florida based, we saw this go on in Florida before, and it dramatically went up, dramatically went down. Now it's a national level. And also even on property taxes, is that something outside of people doing appeals, is that something, if everyone's saying, all the smartest people in the industry are saying values are down, will we ever see actual property tax evaluations go down, which could eventually lead to the bottom line?
Jordan?
Well, first of all, as far as real estate taxes go, you're right. I think people should be appealing their real estate taxes to reflect today's market values. And again, we don't know if values go back up, then of course it's going to trigger on a sale. And so when people are looking at acquiring properties, they're going to look at the reset real estate taxes. But as far as insurance goes, you're right. And a couple of insurance companies that I've talked to, the executives there, some of them do think that insurance will come down. But it's so hard to tell. And
there's no carriers in Florida. It's impossible. As Chubb is the only one.
I mean, it's so volatile and subject to storms and other natural disasters.
Do you think the government
God
are going to
forbid.
step in? Do you think the government are going to?
I don't know. Like they did back when we had terrorism insurance. Thankfully, we don't have that now, but the government did step in then.
Yeah. Matt, do you have an opinion on that?
I think on the tax front, you might get your assessment down, but then they got to raise the millage rate. The positive news is home prices values are going up.
Yep.
So if our values are going down, but theirs are going up, maybe they won't need to raise the millage rate as much if we can bring ours down. On insurance, I think, yes, there's a chance. It's happened in the past. I mean, if you look in the early 2000s, they really spiked. I think if interest rates go down, that puts some relief on insurance, because why would you invest in insurance today when you can buy a treasury at
Correct.
5%? So I think if rates come in, it could alleviate some of that.
Gentlemen, we're run out of time. I want to say thank you to a tremendous panel. Thank you, guys. Thank you for attending. Have a great afternoon.
Good to be